Well, things are certainly moving quickly in the economy. 2 weeks ago when I spoke to you, we were bold enough to say there will be a recession when most people were in denial about that. And then 4 days later, when we had analysed the government's first stimulus package, we said no, there will still be a recession, even though most commentators thought that would be enough to get us to avoid a recession. Last week we talked to you about an unemployment rate of 7%, but things have moved a lot further, a lot more quickly than that. And of course over the weekend with the shutdowns, that has changed the face of the outlook for the economy quite significantly. We now expect that the unemployment rate will reach 11.1% by the end of June, and that will involve 814,000 job losses over that period. The way we arrived at that forecast were normally when we forecast employment and growth, we typically look at the outlook for consumption, business investment, exports, etc. But on this occasion, because the job story is so important, we thought we could get a better lens on that by looking at particular industries. So we considered all the major industry sectors of the economy, and of course marked down sectors such as accommodation, recreation, retail, manufacturing, construction. So we've identified what we consider to be the job losses that will occur in those sectors. There are some winners. Obviously there'll be more jobs in health. We think also in public administration and telecommunication. So looking at all of those details was the way in which we arrived at that forecast of 814,000 job losses by the end of June. The September quarter is a difficult one. We were pretty optimistic that we would start to see the recovery blooming in that September quarter. The government is now talking about a 6-month period of shutdowns. So we expect that the September quarter will probably see the turning point in a number of new cases of COVID, which will give markets a lot of encouragement, but the economy will still be very soft and the government will be slow to release a lot of these shutdowns. So we expect over the September quarter no further job losses, but not much improvement on the jobs front either. So 11% still as the unemployment rate at the end of September, and the December quarter is where we would see substantial improvement. The shutdowns being ceased, confidence coming back to markets, and we would expect about 350,000 new jobs in that December quarter. So we'll end the year at 8.8% unemployment. That's still a long way away from the 5.1% that was reported for February last week, but it certainly would be moving in the right direction. Over the year, we expect the economy therefore to have contracted by 3%. And in the June quarter by 3.5% just in that one quarter. So a big negative number for 2019 and clearly qualifying for the definition of a recession. 2021 will be a year when things will gradually improve, but we're not optimistic that we'll see that 5.1% unemployment rate any time in the future. Support will come from the government. We saw the government's 2 stimulus packages costing about $62 billion in the fiscal years 2019, 2020 and 2021. And another $40 billion is mooted. When we combine all of those numbers with our expectation on the weakness in the economy, we get some pretty eye-popping numbers with regard to the deficits and the associated issuance of new government bonds. So overall, we expect that there will be an increase in the supply of government bonds of around $250 billion. Bear in mind that the current supply is $540 billion, so you're going to be almost increasing the supply of government bonds over the next couple of years by around 50%. That is going to create substantial challenges for the financial markets. And of course, one of the soothing factors here is that the Reserve Bank has now adopted the policy of actually buying government bonds. But the volume of government bonds they've bought so far is minuscule compared to that new issuance that we'd be looking over that course of a couple of years. So that's going to represent quite a challenge for markets and is something that we'll be watching very closely. So some huge developments over the last few days, some very, very disturbing outlook for the labour market and for growth in the economy. But unfortunately, this is the nature of the times that we're going through at the moment. Thank you.